my topic for today was scarcity in the land of the plentiful. And it's usually just touching on two topics, which is cars and houses. And I think houses we have already touched upon in the previous episodes. But today I want to talk about cars because I actually went through this experience. And I think we talked about buying a car last time, but I actually bought the car. I bought a Toyota Highlander. I'm very happy with the car. It's a 3.5 liter V6, and it's powerful. It's a beast. I love America. This is what America is about: power and gas consumption. And I'm actually calling up these dealerships all around the New York metro area to see if there are the Highlanders I wanted, which is essentially, one of the higher trims, and V6, obviously, as we said, and non-hybrid. But I also want the tow hitch. I wanted some other things and like pre-installed, right? Because you could get them installed afterwards, but I just don't want to deal with it. And I literally could not find it in the right color, in the white, which is one of the main colors they offer, right? White exterior. The heat in the Northeast is pretty hot. I'm not sure how it is in Arizona. So the white helps, reflect that heat out. Anyway, so I call a bunch of dealerships and they just don't have it. They're taking deposits for delivery. And I think that scarcity has actually helped the dealers get better pricing power. They're not offering. I could barely, I talked to two of them. They didn't want to go below MSRP, and I really had to fight it to go below MSRP. I know what the invoice is because the Costco website actually tells you what the invoice price of the cars are. So it's a pretty difficult thing to find your car and then after that negotiate. So I started doing some research and I found that there's an article recently from the Wall Street Journal that actually touched upon this. The article is called "Car Dealers Can Keep Rolling After Supply Crunch." And it literally describes how big AutoNation and Lithia, which are big car dealerships, have barely 23 days. Lithia has 23 days of inventory, and AutoNation just has 14 days. And this is down from, the peak of the first quarter of 2020 when at least I think AutoNation had 98, going from 98 days of inventory to 14 days. And this is usually the time they clear up the inventories to start, the summer. At the end of the summer is usually when they really push all the old cars out so they can bring in the new versions of the next year. I talked to some of the dealership people there, and what they said is that they believe this is going to be permanent, the way things are going to move forward in the next 2-3 years, just because it's going to take some time for the chips for the production to start outpacing demand, and then they're just very comfortable doing this. Producing very fewer cars and having less inventory makes it more profitable for everybody in the system.
Except for, it's more profitable for the system to have less inventory sitting, less time on lot. It's not more advantageous to the end customer who doesn't have what he wants in stock away.
I would say the end customer, if everybody's doing this, I would say the end customer, it's like game theory, right? Like if everybody's doing this, and then the customer will wait. So if I couldn't find my car, I would likely put on a deposit and just waited a couple of months to get the car. This is the way cars are sold in like the developing world, right? Like maybe not, big countries like Mexico and Brazil, but you go to Argentina, Chile, like you literally have to put on a deposit to get the car you want because they're going to bring the car from some other country and they're going to load it up in the boat. And it takes a couple of months. Who are benefiting from this? Obviously, it's the car dealerships.
Why is it obvious that the car dealerships are benefiting from this?
They're not having to discount as much as before.
So demand ostensibly stayed the same or went up and supply went down.
Exactly. And so you could see that in the inventory levels, right? So COVID happened. People kind of like, okay, we're a little bit worried. They didn't do anything. They didn't go out. But then they started buying cars because they don't want to take public transportation. So there's a point where that peaked in April of 2021. and then now it's back down. So June, historically, I would say June is a normal month seasonally, but I think a lot of people who didn't buy cars last year bought them in April, and then people who would go buy cars a little bit later probably pushed forward their decision. But I think demand is a little bit higher than usual. Then on top of that, you have transition towards electric, which is happening, and if that's changing anything, I wouldn't be able to tell you. But I think the other winner here is, have you heard of Copart?
Yes, they do car auctions and car part.
So it's very interesting. So they actually buy, or they're partnered up with a bunch of insurance companies. Cars are like way more expensive than what they used to do, and they're more integrated into each other. So if one part gets hit, then the whole car stops working. It's very hard to fix that issue because everything is interlinked, like the computers, the cables, the sensors. It's just easier to total the car and sell it or give it to Copart to sell it. They get, there's people who buy that car and fix it, and so they get enough money there, they can recover more than it would cost the insurance company to fix it. So anyway, Copart has an enormous amount of business lately, and they've become incredibly more profitable because they're able to sell the cars at the higher value, and they take a percentage of that. So used cars, I don't know if you knew this, but used cars in the CPI inflation is up, I don't know, like 44% from last year. It's like the primary component that's driving inflation. You take out like used cars, energy, and food, but energy and food is like you have to keep it in there. Like everybody consumes energy and food. But cars, you take out the cars, and the CPI, the official index of the CPI, doesn't go up so much. I don't know what the exact number, but like if you take out 44% of something that went up 5.6%, that means it has had an outsized impact. And so Copart is doing very well. Mannheim is another one that does car auctions, I believe. They do very well. What's interesting about Copart is like a ton of cars that they sell, like I think 20% goes to international markets. Many of them sit in American lots, and then you have international buyers who are buying them. So my guess is that they're fixing them and sending them abroad as fixed. And you don't have to deal with that issue with the record of a totaled car, right? Because
salvage title
here, like that's a permanent, yeah. So salvage title is not something you want to have in your car. It's unsellable, or it doesn't sells at a discount. And so some cars of those they're better off just loading it up on a ship and sending them off.
Give us a wrap up. All right, you talked about cars, talked about Copart. The scarcity on cars is good for some players, less good for others. Wrap it up for us more broadly on kind of scarcity versus abundance. What's changed? Do you think scarcity is a permanent thing now in the way that's like supply chains have changed in a post-COVID kind of setup?
I'm not sure if the next models will have that same issue with scarcity. I think the factories were closed for the 2021 models, and so as a result, you have a scarcity for the 2021 models. Once the 2022 models come in, I don't know which each individual manufacturer is doing. I can tell you that Hyundai, Kia, like one of those, like who are producing that, like the Palisade, the big SUVs, they're actually going to increase production. They've been outselling all those cars. I don't know to what is certainty, but I know the production won't increase dramatically because of the chip shortages, and it's going to take some time to produce enough chips that go into the car. The supply chain is constrained all along. And then you just have to figure out if you're a market player, if you invest specifically in not in indexes, but also actively in the market, then the idea here is to figure out which companies will win. And I think Copart, Mannheim is a privately owned company by Cox Enterprises, I think it's called. Cox Communications is part of it. But Copart is publicly owned. So not sure if that's a good investment. You just have to do your own research and talk to your own advisors. But just so you know that's a big player in there. we've already talked about housing before, but like it's the same situation here. It's like there's not enough housing, there's not enough land in many places. You can't ramp up production so quickly. The whole thing is constrained.
Constraints, constrained supply, housing, autos specifically. I've got one more to throw in the mix. It probably won't affect you, but it could, which is water. The Western United States is experiencing an extreme drought, if you're not aware. The lakes that supply the water for much of the southwestern U.S. the lakes are very, very low. Politicians are scrambling. Big agreements are being negotiated and signed as to who's going to get the water, what the water can be used for. It's a really big deal out here. And it's something that I feel like doesn't get talked about much because it's quite scary to look at it in the face and say, what if our entire region where we live can't sustain human life because we don't have enough water, right? It's really a tough thing. And it's not something that we currently don't have the brute force to fix it, right? Like we don't have the ability to just grow the economy, lower interest rates, and create water. Like it is fundamentally there or not there, and it's a lot of it's out of our control. So that's what comes to mind when you say scarcity, less so than cars. But cars are scarce. Houses are definitely scarce. Water in the West right now is certainly scarce, and I think the tough part about that is that in California and Arizona, an incredible percentage of fresh water is used for agriculture, and agriculture, as you can imagine, is pretty central, pretty important to us keeping going and moving forward in our country.
Do you think though the stacked agriculture, greenhouses is the way to go in the future?
I don't know enough about that to say one way or another. I know that there is some artificial nature to growing in such dry climates. So like when seasons have been really good in Arizona, when we've had very wet seasons, it's been practical to grow like tropical things. Like you could grow avocados in Arizona in those wet seasons when we had just excess water for farmers to use. But I think on the whole, it's not that practical to grow stuff in the desert. It just takes more water per unit of output. What we do have is sun, right? We have like really abundant sunlight. So if you can get water to deserts like the Sonoran where Phoenix is, you could make that work. Ditto with a bunch of deserts in California. If you've ever driven Arizona to California on I-10 or I-8, you've seen a ton of these enormous farms. Whether we stack those up and, use some efficiency there. I mean, I'm sure that there's people thinking about this very deeply. It's not me though.
The consumption of water is unsustainable right now unless you start bringing in water from far away from the north. It's just not feasible to consume so much water.
Yes, I watched an update on like a documentary update on the state of desalination as well, which is still super energy intensive and really tough on local oceans right now. Desalinating
the brine just has to exit somewhere.
Exactly right. So
usually what they construct is a pipe that goes out like a tree,
fans it out
through a tree pipe, and you just but it's unless you have strong currents that open it up,
it can be really destructive. Yeah I think Israel does a lot of desalination. They're a global leader in that.
So what have they done specifically? Mostly desalination, right?
They just have a progressive look at water consumption and water use. So like on the individual household level, Israelis have much more bought into the idea of water responsibility than Americans have. Americans are not, in my opinion, culturally remotely ready for responsible water use, giving up their golf carts and their lawns. And
no, I mean, like I have visited there, and I remember like in every hotel you have like please be responsible with your showers and like don't take a bath. And in terms of water, also the other thing is they use a lot of water dripping for agriculture. It's just like a bunch of pipes that are set right where the plant is, and they just drip water slowly.
Should try to be as efficient as possible.
Yeah, use as least as possible, and not like water. Then between plant and plant. Imagine if there's 10 feet. You don't want to irrigate the middle of it. You want to drop that water right on the plant. Agriculture is going to have to change, I think. I don't think it's going to leave the Southwest U.S. It's just going to be different. They're going to figure out something, and they're going to make use of less and less water. Yeah, so that's the big thing. In terms of market, have you seen the volatility recently?
I have. I've experienced it directly.
How is your, crypto investments?
Crypto's hurting, man. Crypto's in a rough spot. So Bitcoin's half off its all-time highs, Ethereum less. Anything outside of those two really, really hurting. I listened to an interesting discussion on Up Only TV yesterday with some whales.
Up Only?
Yeah, Up Only TV. Good podcast, a funny podcast. Some whales discussing whether this cycle is over, right? Whether we're down or up, some prognosticating, which of course nobody knows, but mostly bearish outlook from the people that they had on. Today is green, at least in Bitcoin as of this morning. But I don't know. I don't know what that looks like, if there's still an appetite for that type of risk, if the shape of the market has really changed, whether institutions care, whether institutions have a floor at which they would actually be buying any of this fake internet money. I don't know. It's really hard to say. The volatility stays there. That part of the promise has not been broken, that's where the risk premium lies. It's still there. So I'm glad that's still on.
So we had the Bitcoin update. Where do you think it goes from here, you personally?
I'm a great person to counter trade on just gut feeling. I think I'm bearish. I think we see 12 or 20K in Bitcoin before we see a new all-time high.
How come? What is driving you towards that? Do you think it's just, panic selling?
Yeah, I think we had more leverage this cycle. I think there's more sophisticated people involved.
150 to 1 leverage.
Yes, 150 to 1 leverage. I just think that I don't know. It feels like the narrative that this is the siren song of the end of the bull market, of the bull market of everything, right? The everything bubble. That resonates a little bit with me, that we're in, AMC, Robinhood, Disneyland of speculative risk taking, and that crypto is the place that explodes first and truly loses out on this. I think the ecosystems will still continue to work. There's plenty who have plenty in the coffers to keep building and keep iterating. FTX just raised so much money, but the markets are not responding to good news, and that's a really bad sign. Like A16Z just raised the biggest crypto fund of all time by a huge magnitude, and markets are like, eh. In January of 2018, I went to the ETF conference. I can't remember what it's called. It's just the big ETF conference. And Matt Hogan was the CEO of ETF.com. He was putting on the conference. And at that conference, he announced, and this was when Bitcoin had just started busting bad. So the peak was in maybe November. We had gone from 20 to 16, 17, something like that in Bitcoin. I remember my Airbnb host was this older guy, and he was asking me about it. Should I put in more? Should I put in more? I'm like, man, I don't know. Shout out to that guy. Hope he's all right. Really nice guy.
Yeah.
Matt Hogan announced that he was leaving the ETF world and moving to Bitwise, where he still is the CEO or CIO or something. It's a crypto index provider, right? They do crypto index funds, and he was trying to be an innovator there. And he had another guy from his new firm come up and talk, and the crowd literally booed at it like a professional conference. They're like, this sucks. We hate it. It's a bubble. It was pretty wild. So Matt was a little early in his jump. He could have stayed in the ETF world a couple more years and then done the Bitcoin stuff. But yeah, no, you're right, man. These things are cyclical. But there's an argument to be made that these big bounces, these big cycles could have ended, right? The enthusiasm could, this could be the most, this past run up to 60K could be the highest that Bitcoin ever sees. People rarely talk about that possibility. It's totally, totally possible that enthusiasm wanes and that it becomes this niche little thing that exists in the background, not the head of every other headline.
Yeah, and that's something that worries me for a lot of people, right? Because there's a significant amount of people who have put vast majority of their net worth into these crypto assets.
Yeah, and if you're a Coinbase employee and volumes are down 90%, that's a little worrying too. Would you say that on a one-to-one comparison, owning Coinbase stock versus owning Bitcoin directly, that one is riskier than the other, or that you prefer one over the other? No, just the risky side. Which do you think is riskier?
It's tough. It's tough to say what is riskier than the other. At the end of the day, like which one will have a better return in the next 10 years? I don't know, because if I look at the miners in gold, I can tell you that most of the miners underperform gold. There's many of them that have outperformed gold, and the reason is because you mine gold, you sell it, you make the difference, right? The difference is way smaller sometimes than the jump. Like, you look at Barrick Gold, for example, and this is their all-time performance. Last 10 years they've had negative returns. Last 3 years they've done pretty well, but not so much well. There are very few periods of time where they have outperformed the market. S&P 500. I remember doing this a couple of years ago. So we took the last 10 years, and you have the Spider performing better than Barrick, which is one of the bigger gold producers. If I do the max goes back to 2005, 2004, and you have the Spider performing much better. If I go an ETF of gold miners, I'm going to go the ETF, and it's very similar because I think Barrick is one of the bigger ones, so they are overrepresented in the index. There you have it, the max, which is a little bit before the gold rush, but still, like, the gold goes up, the companies don't perform as well. This is my skepticism here. I think a lot of the gain from the gold is absorbed by management.
That's what I was thinking too. So I'm thinking on the Coinbase versus Bitcoin debate. The question is whether this company, I mean, it's not a perfect comparison to gold miners. They do something a little bit different. I would say it's a little bit closer to like Charles Schwab versus stocks, maybe. I don't know, a brokerage, right? But the idea is, all right, is irrespective of what's happening to the price of the underlying commodity, is management adding or subtracting value? Are they subtracting value by extracting it for themselves and paying it to themselves? Or are they functionally adding, innovating, diversifying risks, really doing a good job there? And that's it, right? Like that's the difference in negative return and compounding compared to kind of the beta of the space, which is the underlying commodities performance.
I'm curious of what the right strategy should be here.
It's my personal opinion that owning Coinbase stock is actually a riskier proposition than owning Bitcoin. And that's mostly a valuation and competition view, not financial advice. Coinbase could be an awesome investment. Talk to your own advisor, yada, yada. But Coinbase still trades very expensively compared to how much money it earns if it were not an exciting crypto company. And it's got a lot of really, really good expectations priced into it. And not that Bitcoin is cheap on any fundamental level, but that's my view. I think management has a really tough road ahead of them. I think the crypto space is incredibly hot, incredibly competitive. FTX is coming. They just raised, I don't know, another $1 billion. BlockFi is another big crypto company that's had regulatory trouble lately. New Jersey Attorney General sent them a cease and desist to stop paying interest on crypto balances.
We're going to see way more active regulators in the market. I think the problem they had is it's tough to understand the whole crypto space. Even I'm not as involved as other people, but it's not easy to understand the entire space.
I would argue that it's not only not easy, it's impossible to understand the entire space. It's moving so quickly, involving so many people and so many projects, unless you're literally full-time researching. And that's a job that many people have. People have jobs as full-time crypto researchers, just synthesizing, reading, producing, trying to drink from the fire hose of stuff going on.